safety of the curve. Who doesn't like to reside in the safety of the curve, guys? Well, we all like that because it doesn't rotate very much. It doesn't rotate very much. So you might look at it and say, but that's a fairly sizable rotation there today. That's a fairly sizable chunky bit of rotation from the curve itself. But yeah, but let's take a look at it. It's not the curve, remember, that we're trading. I'm not a buyer or a seller necessarily of the curve. I'm just looking at these rotations. I'm looking at these pin rejections. I'm looking at these balance areas on the curve. And you can see, okay, so we went a full measure to the downside. However, if I'm looking at this curve from the absolutes point of view, oh, wait a second, everybody starts going, whoa, wait a second, the absolutes versus the curve itself. Does anybody see any trades on that? All of a sudden, trades just pop off the page at you. You can see that there's a very clear bottom line in here, isn't there? Now, you've got to make sure that that's priced in, which you might say, but surely the first trade was in here. No, it wasn't, because this drop hasn't yet been priced into the marketplace. So when I see the first divergence, I just believe, for example, if I look at the absolute rate curve from here to, for example, here, and I say, well, obviously we're trying to price this in properly, and I take it from the curve to there, that's about fair value now. It's just fair value. So I need more than fair value before I can take a shot at this. So obviously when I'm looking for more than fair value, that's what I'm dealing with in there. I am buying the curve. Oh yeah, absolutely. So when the curve rotates out of the prior swing high here, we're getting short selling into this now. Well, I'm just trading the short sell on the curve. So when we come into the bottom edge and you're saying, well, this looks fair, and then it sells off, then you've got to give it some space to sell off. Well, that's probably starting to get unfair here, but you're still on a drop. I like the curve buy trade in the next candle, though, because the curve's actually going in the opposite direction. And you might say to me, but Ray, we've got there's nobody in this room wants to trade the 2s, 10s interest rate curve. And you're probably right. There probably isn't anybody in the room that wants to trade the 2s, 10s rate curve. But if I'm not going to trade the 2s, 10s rate curve, Reeve, what am I going to be able to trade instead of it? The bond. Whether you're trading the ZB, the UB, or the 10-year, makes no difference. This is going to be a trade on treasuries. This is going to be a sell on treasuries. This is going to be a sell on treasuries. This is going to be a buy on treasuries. This is going to be a buy on treasuries. And this is going to be a sell on treasuries. Make no mistake about it. These are going to be treasury trades. So when I put the UB contract or the ZB contract on this, you will see the trades. A sell on treasuries, a sell on treasuries, a buy on treasuries, a sell on treasuries. Unbelievable, massive bond profits. And you're not trading the market chaos of everything else. You're just trading the 2s, 10s absolutes against the 2s, 10s. It shows when the futures are overpriced or underpriced, rich or cheap to the curve. And if the futures are rich to the curve as they are up here, we are cheap to the bond price here. When the treasuries, when the treasury futures are cheap to the curve, here we are expensive on bonds. Sell side only bonds, guys. We're not taking any nonsense from the curve. We're not taking any nonsense from the chaos. We're simply trading the simple stuff that has an incredibly repeatable, high probability of giving us overshoots, like Reeve says, overshoots on the futures markets, so that we can get those overshoots in the futures and take advantage of them. That's what we're doing. The absolutes against the 2s, 10s. It's just the futures against the base. It's called the basis trade. And because it's called the basis trade, you know, if anything that's called a basis trade, you know it's an arbitrage, right? It's not a statistical arbitrage. A basis trade is an actual physical arbitrageable event because it's the same marketplace. You understand that? It's like looking at oil cash price against oil future. It's the same product. It's just a calendar between the two. It's called the basis trade. And if you get value on it, it is arbitrageable. Now, obviously, for it to be arbitrageable, you've got to trade both of those two things. You've got to trade the physical bond versus the future, of course, if you're trading it as an arbitrage. But if you're not going to trade it as an arbitrage, the value is always on the future. Always. So when we see that value popping on the future, it gives me a massive opportunity to trade the safe stuff on the treasuries. And obviously the treasury stuff on today's markets have been, it's almost been pointless going anywhere else. There's been that much value on bonds today. Crazy stuff. Classroom guys in 15.